Good afternoon and welcome to this week's Elite Traders Club education session. December the 2nd, 2015. The topic for this week is order types. I think it's reasonable to go back and just revisit the various different order types, again, particularly for those of you that are newer to the Elite Traders Club. And even those of you who've been around for a little while, just making sure that you're continuing to go back over things that perhaps at one stage you may have assumed that you knew, just to make sure that you actually do. Alright, first and foremost, our disclaimer: the content of today's presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances. All right, let's go through and have a look at what we're going to cover today. A number of different order types. And quite often we talk about either at market, on stop orders, on stop with limit orders, or just plain old limit orders. So let's go through each one of these and see if we can make head or tails of what exactly each one means. A market order. Market order is placed into the market and filled at the best available current price. So it's an order that you don't impose any restrictions on. So it's really just a matter of placing either a buy order or a sell order, in which case, in the case of a buy order, your order goes directly into the market. It may experience some slippage if the market's moving very quickly. Your order may take a while to be filled if the stock's particularly illiquid. So it will just sit there until your order is filled, and because you haven't set any specific price, it will fill it at any price on stock that is actually available in the market at that particular time. So as it suggests, it's a market order. It goes directly into the market and no restrictions are applied to it. So it's really just an order to get into or out of the market as quick as you can. The next order, typically that we talk about very frequently, is an on-stop order. So an on-stop order is essentially an order to buy a stock in this case, which is entered at a price above the current market price. So this is the sort of thing that where we're placing an order into the market above the current price, and it may well be, above, as in normal circumstances, a previous medium-term peak. So we're really waiting for price to prove itself to get to that particular level. So by placing an on-stop order, this order is only going to be triggered when the market price gets to that particular level. Now, when it does get to that particular level, that order then goes straight into the market and becomes a market order. Now, as a result, it may also experience some slippage. On-stop orders are very, very good for breakout trades, which is our main methodology in terms of ETC at this stage. So it's an order that's used for those breakout trades where we don't have to sit in front of our computer all day waiting for price to get to a predetermined level. Using the on-stop order means that it will just sit there until price reaches that predefined point. The next order is the on-stop order with a limit. Now, an on-stop order is great because it saves us a lot of time. We don't have to be watching the market until price gets to that particular level. However, there is also the possibility, particularly when we're not watching what's going on in the market during either market hours or perhaps if we're trading overseas markets, for price to reach that particular stop level and actually gap above it. So that might be during the course of the day. It's just about got to that level and it might experience a bout of frenzied purchasing or buying or demand pressure and actually jump past your initial stop. It can also happen at the beginning or the open of a session where there is so much demand in the market that price instantly upon opening also jumps above your stop level. That is the point at which you want your order to become triggered. So if you just place a normal on-stop order without a limit, then wherever that price effectively starts to trade, and that may well be a significant level above your initial entry, that's the level at which you're going to be filled, for better or for worse. By placing an on-stop order with a limit, that caps or it contains the price. Now, if price doesn't open within that window between where you are placing the on-stop order and the limit, if price doesn't open within or trade within that window, then your order will not be filled. And so one of the benefits of placing an on-stop order with a limit is that it helps to reduce the amount of slippage that you may experience, or in worst case scenario, actually save you the pain of experiencing severe gapping where price has opened up a long way above your on-stop order. So certainly a very good order to place. Not all platforms will have on-stop orders with limits. I'll just go through and have a bit of a look at an example of a potential on-stop order with a limit on Bega Cheese here. So you can see that in terms of our structures set up, the price action is ticking all the boxes, the relative strength is increasing in all three time frames. All we have to do is get past this last medium-term peak. We're at all-time highs. Now we've had quite strong movement up and we've had a fairly shallow retracement. So there may well be the potential for price to experience quite a significant amount of demand and on any occasion gap up. So we can see that the last close was at $5.86. It may well be, depending on how much demand pressure there is, that this stock gaps up and opens at $6.60 as an example, if there was a lot of enthusiasm about this particular stock. Now at this point in time, we've got an entry level here that you can see at $6.05. So that's 0.5% above our last medium-term peak, which is where we want to set our on-stop order. Now, but at the same time, whilst I'm happy to get in once price breaks out through that level, I don't want to get into this trade should the price open, for example, up at $6.40. That's giving away far too much profit, if you like, and getting us off to a bad start. So what I'm wanting to do here is to place my on-stop order at $6.05 as an example, but I also want to make sure that my order is filled before it gets to $6.15. Okay, so I'm putting on an on-stop order at $6.05 with a limit to $6.15, just as an example, a hypothetical example, just to demonstrate that I want to get filled on this trade in between that particular window. If price happens to open up at $6.40 and never looks back, then I won't be triggered into this particular stock. If it happens to open at $6.40, but during the course of the session happens to come back down in between this window, then certainly it will be triggered at that point. But if price happens to gap up and keeps on going, well, it will just mean that I've missed out on the trade. So certainly an on-stop order with a limit makes a lot of sense, particularly if you're worried about slippage or excess slippage. And it's something that is quite often used in for our trade setups in the US because of the increased volatility in that particular market. All right, so we'll go back through now and have a look at our last order that we've got, and that's a limit order. Now, a limit order is primarily used to take profits. So when a target has been set initially, so as an example, you might have a stock that you've been in since around $2 and it's getting towards $5 and you think, well, $5 is sufficient. Once it gets to that particular level, then I'm going to place an order to sell. So by doing this at the beginning of your actual trade setup, when you're initially placing the trade into the market, you can also place a limit order at the same time. And that just means that your objective, should price happen to get to that particular level during the course of market hours, that objective, that order, will actually be actioned as soon as price gets to that level. So a limit order is primarily used as an exit strategy, So the good thing about this, again, is that you don't need to be watching the markets, waiting to see where the price is going to get to a particular level. So it will just sit there until that objective is reached. Now, if that objective isn't met during that particular time, then the order will sit there until the next session, on a continued basis until either your target is achieved or you choose to cancel the order by yourself. So again, so 4 different order types there. Market order, obviously getting into the market straight away or out of the market straight away. An on-stop order, which is primarily what we use to trigger our trade entries, very useful for breakout trades. An on-stop order with a limit is very useful for breakout trades and particularly useful to reduce the possibilities of detrimental slippage. And the last order, a limit order, is an order placed into the market to sell a certain number of shares at a specified price or better. Okay, so if I wanted to get out at $5 and price happened to gap up and get reach up to $5.15, then that's a much better price on getting out for my profit. So my order would go through at $5.15. So again, primarily used to take profits. Right, well, that's the end of the ETC education session for this week. Hope it's been beneficial. If you've got any questions about different order types, you certainly know what to do. Just request a coaching call and we'll pick up the phone and be in touch ASAP. Thank you for watching.